Now, Trump has been raising Cain in the White House, telling Walmart, don't pass any of these tariff increases on to your customers. Don't pass that tax on to your customers. What we're seeing is the onset of a slowdown that will eventually lead to a recession late in the year. And with that, once the labor market starts weakening, once the economy starts slowing down, the Fed will then lower rates.
Steve Hanke is back. He is a professor of applied economics at Johns Hopkins University. We'll be getting his outlook on markets and the economy and factoring some recent news. Professor, welcome back to the show. Always good to see you.
Good to see you, David.
We haven't talked about the latest inflation print, you and I. I don't think it was a couple of weeks ago since you were on the show. So let's revisit that. Let's talk about some recent trade activity, and let's talk about the bond market first. Bond yields surging. Are you surprised at this, first and foremost, and what is it signaling? The 30-year above 5% now, I believe.
Yes, well, the inflation story kind of comes into the bond picture because what's going on with inflation, actually, it continues to come down. As you know, based on the quantitative theory of money, John Greenwood and I have been pretty accurate on forecasting and anticipating the course of inflation. We got it when it spiked up. We said it would go up to 9%. It went up to 9.1. And we said it would end last year at 2.5 to 3%. It ended at 2.9. And we said this year it would come down and hit the inflation target, maybe even go a little below, because, of course, it's all based on what's going on with the money supply and prior years. And the money supply has been literally flat since April of 2022. The stock of money today, broadly measured by M2, is almost exactly where it was way back in April of 2022. And the rate of growth in the money supply is only anemic, 4.1% in the United States. And as you know, Hanke's golden growth rate, a rate consistent with hitting a 2% inflation target, is about 6%, a little north of 6%. And so we have the stock of money flatline. We have growth in the money supply year over year, anemic. And the inflation keeps coming down. It's 2.3%. Now, yields on bonds usually follow inflation. So you would expect the 10-year, that's a key bond, an important reference point, to be coming down. Well, actually, it's inflation. The money supply is contracting. It's anemic, and inflation is contracting. And we would expect the bond yields to be the third aspect of that. They would be declining. But the 10 years has gone up ever since Trump got on this tariff rampage and the first part of April. And so we have a tug of war going on. On the one hand, we've got inflation coming down. That should be pulling the bond yields down, but that's being overwhelmed by what I call regime uncertainty. And that is, it's not only the tariffs, and everybody keeps talking about the tariffs. Trump has backed off of the tariffs. Well, he has backed off of some of the, he had them, 145% or something he was going to levy against China. And now he's backed off of that. But the average tariff rate today, as we speak, is 18%. If nothing happens and nothing has changed from where they are today, overall international tariffs imposed by the United States would average 18%. And that's a big increase from where they were. They were 3%. So the idea that somehow, we backed off of these catastrophic tariffs, but we're imposing, if things stand as they are today, very high tariffs, a huge increase in tariffs. And of course, we're uncertain about where the game will end. So
But
you have regime uncertainty, David, coming into play. And the uncertainty is not just with tariffs, but it's everything under the sun. I mean, the Trump administration is changing everything. Uh, just today, the big headline was they're in this war with the universities, Harvard in particular, and they're going to prohibit the Harvard University from enrolling foreign students. Can you imagine?
why are they doing this? I wasn't aware of this news actually.
Well, it just happened, within the last hour.
Wait, what's the story there? Let's just talk about that briefly.
The story is that the administration is going to prohibit Harvard from enrolling foreign students.
You're serious?
Well, that's as I assuming Reuters and everybody's putting out these headlines.
Foreign students, like any foreign student, or just
any foreign student?
Is this okay? I'm sure lawsuits are on their way, but okay, what do you, as an educator of a tier 1 university, what do you think of this?
Well, I think it's regime uncertainty on steroids. I mean, this really upsets the apple cart, and of course,
Wait, what does this have to do?
I'm against it. I mean,
Yeah,
I'm a professor at Johns Hopkins, and I can attest to the fact that I have many foreign students, and in my 56 years of being a professor at Hopkins, I've had many foreign students. So, so this is a new wrinkle in things, but this is part of this regime uncertainty. It's not a specific. There's always uncertainty, but it's usually focused on one or two things. Now, regime uncertainty means it's focused on the whole regime, upsetting the whole apple cart, all the rules of the game. And the only time we really have had this in the United States before is during the New Deal and Franklin Delano Roosevelt during the Great Depression years. The New Dealers were changing everything. It became illegal for Americans to own gold, for example. Gold clauses in all contracts were revoked. They were adding new departments, changing, trying to stack the Supreme Court. All kinds of things were going on. That was regime uncertainty. Now, what was the result of that? The result of that was that the Great Depression lasted a lot longer than would have otherwise been the case. And that was because investment just completely dried up. From 1929 until the start of World War II, there was essentially no investment in the United States. And think of what's going on now with regime uncertainty. We're talking about the bond markets and the tug of war. Inflation coming down should be driving bond yields down, but regime uncertainty with Trump is driving them up, and that regime uncertainty is overwhelming the downward draft of inflation. So that's the bond market, and if you look at the stock market, I think the economy will slow down and we will have a recession. The 1-2 punch will be slow monetary growth, means that baked in the cake, we have a slowdown coming in the economy. No matter who the president would be, if it was Harris, it was Trump, all the same. It would slow down because of the monetary slowdown contraction. But we've got Trump and we've got this regime uncertainty added to the picture, which is going to push the economy further down and slow things down as it did with regime uncertainty in the New Deal era. So that slowdown and the regime uncertainty all factor into what's been an increase in bond yields. The 10-year is up, a little north of 4.5% today, and also the stock market. We have bonds and we have stocks. Well, the stocks are doing very well. They haven't been touched by this so far, but I think the consensus earnings growth for earnings in the United States they have been revising it down, 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 down. They started in low double digits and for earnings growth year over year, the consensus, and now it's down around 7%. I think it will be zero. I have an article about this in Fortune magazine. Zero or a little below zero. So the stock market's in for, I think it'll take a tumble.
If I offered you a $100 bill, but you had to pay me $115 for it, would you take that deal? Of course not. But that's exactly what happens when you purchase gold and silver, and high dealer markups at significant costs to each purchase. Well, that's where today's sponsor comes in. Today's sponsor, Bullion Standard Pro, is a membership-based platform providing direct access to wholesale pricing on precious metals. The same pricing dealers and retailers pay, like Costco, for example, except for gold, but without the 40-pound Mayo jars. By aggregating live market maker bid-ask product data, it offers real-time pricing with significantly lower spreads compared to traditional retail markups. For context, traditional dealer spreads on popular bullion products can exceed 23%. With Bullion Standard Pro, these spreads can drop as low as 2.1%, offering you a cost-effective way to buy and sell precious metals. How much can you save? Hundreds, if not thousands of dollars on a single order, depending on the order size, of course. So to learn more, visit bullionstandard.com/pro and use the promo code David Lin. Your first month of membership is free, with no commitment required. Link down below or scan the QR code here to get started. Invest smarter now. Even despite the rally that has transpired since the beginning of May, which indicates that investors, at least stock market investors, are not concerned about an economic slowdown, at least for now, Professor.
Well, that's true, but the stock market's been, a very poor predictor of where the economy is going.
What usually leads, by the way, the stock market or economic growth?
Well, what usually leads is what's going on with the money supply. That's the key is what's going on with the money supply.
I want to come back to the money supply because earlier you said.
So, by the way, on this earnings thing, just one little footnote and the regime uncertainty to give you an idea of how the regime uncertainty is working. Is that many companies now are not issuing forward guidance on earnings. They just don't know what. Excuse me. They just don't know what to do, so they just stopped issuing guidance. Many firms. So that confirms what I'm telling you about regime uncertainty. If firms stop making forward guidance on earnings because they have no clue what's going on, there's a lot of uncertainty in the air. Mm. But that isn't priced into the market at all. Mm-hmm. The stock market, it is, the bond vigilantes have priced it in. But the stock market, no.
Well, let's come back to the money supply in just a minute because I want to bring up a comment you made earlier. But let's take a look at my screen first and look at the deals that President Trump has been making on his tour to the Gulf countries. This came from the news just a couple days ago. What are the Gulf trillions that Trump says will boost the economy? So President Donald Trump was wrapping up his Gulf tour on Friday, having secured what the White House says is over $2 trillion for the U.S. economy in combined deals. Based on a Reuters tally, the value is over $700 billion. But it includes U.S. defense equipment, data and technology agreements, and other contracts. Of the corporate agreements worth up to $549 billion during the Trump's Gulf tour, many were non-binding memorandums of understanding. The defense sales agreed with the Saudis and Qatar took overall tally close to $730 billion. Now, Trump has said that this is going to turn the economy around. Will it?
Well, I'll believe it when I see it.
Okay.
If you get the drift of things, I mean, Trump makes a lot of statements, but
by the way, does FDR
it's a little bit like Musk and Doge, the Department of Government Efficiency. They spot a lot of waste, fraud, and abuse, but the question is what they spot. The magnitude of that is one thing. and whether they're able to stop it and rein it in is another. And the numbers don't match. They claim big numbers and waste, fraud, and abuse, which might be true, but the question is, I'll believe it when I see it. When they wring it out of the system, I'll believe it. And it's exactly what happened with us. During the Reagan administration, the first term, I was, of course, on Reagan's Council of Economic Advisors, and during that time, Peter Grace was the chairman of the Grace Commission, and he had a beautiful study, spotted all kinds of waste, fraud, and abuse, many ways to cut government spending, and big numbers. But what actually happened? Very little.
Yes.
And Doge is going down the same path. It's because the people who want to squeeze the waste, fraud, and abuse out of the government, you don't realize how hard it is to do that.
By the way, Professor, generally speaking, does foreign direct investment contribute to the money supply? Suppose we have foreign actors buying U.S. Property or plant and equipment, or in this case, defense equipment, whatever the case may be. Does that investment get fed into M2?
No.
Okay, so all right, so it doesn't have anything to do with the money supply. Let me just take a quick look over at my screen at the money supply. Earlier you said that it's diminishing. I just wanted you to clarify what you mean by that, because according to St. Louis Fed data, it's still climbing by the order of 4% a year.
Yeah, I did say that, 4.1%. It should be, if it was growing at a rate consistent with hitting the inflation target of 2%, it would be growing at around 6%, maybe a little more than 6%.
Okay.
So it's growing, but growing slowly. And if you look at the stock of money, the total stock, if you had a Fred screen of that, you'll see that where the stock is today is exactly where it was in April of 2022. It's just flatlined.
Yeah, it's gone down and then gone back up again. I think some questions came in for you, Professor. People wanted to clarify whether or not your inflation outlook is going to get revised if this number continues to expand, meaning we continue to get 4% growth on the M2.
No, 4% is too slow. 4% is below 6. So that means that the monetary push on inflation will be lighter than it would be, obviously, at 6%, and it suggests that we could very well see headline CPI numbers that come in at 2 or maybe even a little below 2 at some point this year.
And so far, I'm talking about May, we haven't seen the CPI reflect higher levels of goods prices from tariffs. And I think I brought this up with you last before tariffs were officially implemented, Professor. I said back in 2017 to 2020, when Trump had his first term, the CPI didn't move much, even though he implemented tariffs. People were concerned the second time around because the tariffs are supposedly wider in scale. And, right now the CPI hasn't moved again. So can you comment on
that? The tariffs, and the reason people get very confused about this is that there are two aspects of it. One aspect is that the items that are tariffed are specific items, and those prices may change, especially if all of the tariff tax is passed on to consumers. Obviously, the price will change.
Mm-hmm.
So that's and once they see the price change on these imported goods that have tariff taxes put on them, they say, "Oh, we have more inflation. That's inflationary." No, it's the increase in the relative price of those imports compared to everything else.
Yeah.
And if the money supply remains static and anemic, okay, the tariffed items will go up in price, but other things will go down in price, or they won't increase as much as they would have been increasing before the tariffs. So that the overall aggregate, if you put it all together, it's driven by the changes in the money supply. what goes on inside the aggregate among the 300 and some items that are in the CPI, those things are moving around, and tariffs will cause some of them to move around relative to other things that aren't tariff. So that's one aspect. The other aspect is tariffs are different than if you had a VAT tax on everything in the economy, then the price level could temporarily jump up a notch. Okay, but tariffs, the magnitude of trade in the United States is pretty small compared to the overall economy. I think foreign transactions are only like 15% of total economic activity in the United States. So it's different than a place like England, where it's much more open. They have much greater international transaction activity than the United States. The United States doesn't have much. So that's another way to get it in your head that the tariffs are not going to be inflationary over the whole economy, because trade's a little tiny part of the economy. That's one aspect. The other aspect is, when you think about tariffs, you have to think in terms of relative price changes, not overall inflation. Overall inflation is driven by changes in the money supply.
Professor, has there been a case in recorded history in which people's expectations for higher prices, even if they're misplaced expectations, like from tariffs, for example, would actually pull forward spending? In other words, people expect prices to go up in the next couple of months. They spend now. They buy as much things as they need now before they think prices are going to go up. And that actually creates a self-fulfilling prophecy for higher prices. Does that happen?
Oh yeah, it always does. They're pulling in imports right now as we speak.
Yes.
These imports are rolling in. So you pull consumption forward. And in this case, if you think the tariffs are going up, you pull in imports now rather than waiting for 6 months and worrying about whether you're going to have a higher tariff or not. You import the stuff now. And it's the same with inflation expectations. If you expect inflation to go up in the next year, you'll tend to be trying to buy things now, especially durable goods like refrigerators and washing machines, stuff like that, cars. If you think car prices are going up next year, you buy the car this year, not next year.
Yeah, but that's exactly what's happening. It's crunch time for U.S. importers to import goods while President Trump's higher tariffs are on pause. They're simultaneously navigating complex filing rules when their cargoes cross the border. Everybody's in agreement about these next 2 to 4 weeks being crunch time. I'm just wondering, this is a philosophical musing of mine. If the government wants inflation lower, let's say, why don't they just promise that prices will be lower next year somehow? That's what happened with Japan, isn't it? People thought prices were going to be lower next year, so everyone's
look, because we don't have a Soviet style economy with central planning. The central planners could tell you to do that and announce it, and the central planners in the Soviet Union had the control over the prices, so they set the prices. In the United States, the market sets the prices. Now Trump has been raising Cain in the White House, telling Walmart, don't pass any of these tariff increases on to your customers. Don't pass that tax on to your customers. Yeah. And I think Walmart should tell a president to take a hike on a long walk on a short pier.
Does that work though? If you just tell the stores to stop raising prices, I mean,
this Kennedy, tried this with steel. This is called moral suasion, but Trump does this on steroids. He thinks the U.S. economy is Trump Enterprises.
Well, is it? Can
No, it's a joke. He has a complete misconception of how the economy works.
Okay. All right. So if you were advising, actually,
He's by the way, in his courtiers, and I say courtiers because he's more like taking the role of Louis XIV than he is the president of the United States. And of course, Louis XIV had courtiers, and Trump does have courtiers. You look at all these appointments that he's made, and they all sing from the same songbook.
okay.
And if they don't, he removes them pretty fast.
Well, yeah, I don't think people like to be surrounded by people who disagree with them in general. But your point.
Well, I'm not certain that's the case. I think good, strong leaders who are confident like to surround themselves by smart, good people, and they don't care if they disagree with them. Maybe not in public so much if they're in public office, but or even in corporations. But once a CEO comes out and makes a statement, of course he doesn't like a vice president coming out and contradicting him in public, but he should welcome a good, smart VP who challenges him and maybe even changes his mind. I want to, you want to who do you want to surround yourself? Do you want to surround yourself with a bunch of flunkies who are just going to repeat what you say? No. You want to be surrounded by smart people who challenge you and hopefully keep you. If you get off base, they'll get you on base.
Yeah.
But that's different. That kind of behind the scenes debate, good healthy debate. That's one thing. It's another thing, of course, to have a leader with a bunch of lieutenants that are saying things in public that contradict him. That's a no. That's not a good idea. So they're two different things, and with Trump, it's very clear that he likes them in line all the time, in public and in private.
Look, we can only speculate as to the answer of my next question, but do you think Trump took the tariffs off of China because his advisors asked him to do so, or that was his plan out? It was all a big bluff.
Oh, I think he took them off because he realized that China has lots of aces up its sleeve, and the big aces are all in critical materials, the so-called rare earths, and they're it depends on the list, but usually the International Energy Agency has 20 critical materials on their list, and 19 of the 20 are controlled by China. I mean, China could shut the U.S. down in a hurry if they wanted to, and they know exactly what they're doing. China's been working on this for about 70 years. I have an article with Jeffrey Wang in Fortune magazine where we go through all of this. So China knows what cards it has. It knows it's got all the aces basically, and I think somebody whispered in Trump's ear and said, "Hey, you're playing with fire with these people."
So you think that it's probably unlikely that after the 90-day pause, we'll see tariffs resume?
Well, they are going to be higher than they were before Trump took office. As I pointed out, the average internationally was 3%, and today, if everything stayed just the way it is today, the average would be 18%. That's a six-fold increase, for God's sake.
According to Waller, Christopher Waller, Fed governor, the Fed only needs 10% global tariffs to be at 10% for rate cuts to resume. He said, if we can get the tariffs down closer to 10%, and then that's all sealed, done, and delivered somewhere by July, then we're in good shape for the second half of the year. We're in good position for the Fed to kind of move with rate cuts through the second half of the year. What do you think of that plan?
Well, I think they'll be moving towards rate cuts. They should be stopping quantitative tightening. That the shrinkage of the balance sheet of the Fed. The quantitative tightening is the key thing that's keeping the money supply growth rate at that subpar 4.1% level instead of 6%. So, but what I think will happen, again, I hesitate to get my crystal ball out of the closet, David, but let's do that for a moment here. And I think what we're seeing is the onset of a slowdown that will eventually lead to a recession late in the year. And with that, once the labor market starts weakening, once the economy starts slowing down, the Fed will then lower rates because they think interest rates are monetary policy. Monetary policy is not about interest rates. It's actually all about changes in the money supply. But since the Fed thinks interest rates are monetary policy, the instrument, the Fed funds rate, the one they control, yeah. I think that they will loosen, according to them anyway, as they see it, and lower rates. But they'll wait until they see the slowdown hit them in the eye because they're data dependent. They're looking at daily data. Instead of having a model like the quantity theory of money that accurately predicts the course of nominal GDP, they're just looking at what real GDP growth is, what the inflation is, what the labor market conditions are, and so forth and so on. But once they see those things deteriorating, it'll basically be too late. But they will act.
Do you think they should be acting right now at all? Let's take a look at some news surrounding the labor market. This is from Bloomberg just earlier today, Professor. Jobless claims declined to lowest level in 4 weeks. Initial claims decreased by 2,000 to 227,000 in 1 week ended May 17th, roughly in line with forecasts. This is the lowest level in a month. So it doesn't look like...
Yeah, see that, keep that chart up. See how jagged that thing is?
Yeah, okay.
It goes all over the place. So it's a noisy time, what we'd call a noisy time series.
Yeah.
It's all over the place. So these monthly things, you don't get too excited about them.
Do you think
what you want to do is look at what's behind that trend? And what's behind it is what's been going on with changes in the money supply a year ago, 2 years ago, maybe even 3 years ago.
Let's put it another way, Professor. Given that inflation is primarily, as you say, dependent on the money supply and not so much interest rates, well, then why don't the Fed just fire a bazooka and say, let's cut rates down to near zero tomorrow. Let's eliminate the risk of the employment rate skyrocketing, and at least it won't have any significant impact on inflation right away because the money supply isn't increasing, right? Why not?
Well, again, I would focus on the money supply and quantitative tightening, not interest rates.
Well, that's my point. I mean, they could, in theory, just lower the rates whenever they want, and then at least
they could do that, but is that going to do much? And the answer is, well, I don't think so, because if they did that, by the way, my guess is that would spook the hell out of the markets, and you'd see the long rates go up because the Fed doesn't control the long rates.
I think markets would be excited by a surprise massive cut, in theory.
Yeah, they'd be excited for a while, but the excitement would wear off pretty fast. It would be like going out and getting drunk tonight. You're in Las Vegas, for God's sakes. I hope you don't do that. But,
no.
but let's assume that David Lynn went out and tied one on tonight in Vegas.
All right.
And what would happen? Lynn might feel great tonight, but how about tomorrow?
I'd have a massive hangover breakfast. Speaking of hangover breakfast, what is the economic equivalent of a hangover breakfast here? We've got fiscal policy. Do we need fiscal stimulus right now to help with the fears of people losing
No,
their
no, no, no. This is one of the problems with the bond market. By the way, I talked about regime uncertainty, but one thing that is spooking the bond market is this new uh, big beautiful budget bill that Trump loves so much. That will we're going to go way over the fiscal deficit that U.S. Treasury Secretary Besson says he wants to get the deficit down to 3%. It's probably going to be, I haven't looked at the exact numbers, but it looks like it's north of 7%. It's a huge deficit.
Right.
So and the problem with that is how to finance it. Now, there are two ways. One is if the Treasury bonds and bills that are used to finance it are all sold to the non-bank public, the non-bank public to swallow all those is going to require a higher yield. So that's one aspect of spooking the bond market. The other aspect is what if they take the other alternative and the Fed monetizes most of it, as they did after COVID set in and the fiscal deficit exploded in the United States, and who bought over 90% of the Treasury bills and bonds that were being issued to finance a deficit? Well, the Fed did. And when the Fed did that and credited the government with those for purchases of those bonds and bills, of course, the money supply goes up. And that's what fueled inflation. So it could be a mix, but the two modes of financing the deficit all lead in a way to the same conclusion, and that is yields going up. Because on the one hand, if you're not monetizing the deficit, the yields will go up because the supply of treasuries going into the non-bank public will go up, and if the supply goes up, people will demand higher yield if they want to swallow all of those things. And the other way is that the Fed comes in and the Fed buys. Well, if the Fed buys, the money supply goes up, and you have more inflation, and that causes the yields to go up because yields follow inflation. So, and it could be a mix of the two, by the way. They could be selling some, and instead of monetizing 90%, they monetize 30% or something like that. So we'll have to wait and see. But the point is, they have done the following, and this is typical of Trump. On the tax side, they've been pretty good because they're going to extend the same structure and level of taxes. And they advertise this as a tax cut. It's not a tax cut. It's just keeping what we have and avoiding a tax increase. It's avoidance of a tax increase. That's what the tax side of the budget looks like. That's it. What's bad is that the spending is not being controlled. And some of the spending is ridiculous. I mean, they're having a big increase in the spending going to the U.S. Department of Defense, and the Department of Defense, they've never even been able to audit the thing. There's so much waste, fraud, and abuse there. You can shake a stick at it, and they're pouring more money into the waste, fraud, and abuse machine. They should be cutting that Defense Department budget by 50%. They're increasing it.
Professor, let's finally close off on austerity. This came in from Argentina, and people in the U.S. are concerned about the deficit and the debt levels getting out of control. Well, take a look at what Milei did. Public spending slashed 26.8% last year. Okay, real prime spending in Argentina fell by 5.8% last month. Last year, spending at constant prices was cut by an accumulative 26.8%. Transfers to the provinces were hardest hit by the austerity with a 68.5% cut last month. Okay, if Argentina can do it, why can't the U.S.?
Well, well, 2 points. The one important point is that what Milei has done here is he's put a confidence shock in the system. The economy is actually growing much more rapidly than most people thought it would in Argentina. That's because of the austerity. Most people think austerity is a negative. It holds you back. No, austerity, every time you put in a credible austerity package, you get a confidence shock and the economy actually grows. So that's point number one. Point number two is that in the United States, every time we've tried to rein in government spending with statutory changes like Graham-Rudman bill and things like that, they last for a year or 2 years or something, and pretty soon the Band-Aid gets torn off, and they're spending like drunken sailors again. So what you have to do is invoke Article 5 of the U.S. Constitution. 2/3 of the states have to approve that and have a constitutional convention. And at that convention, focus on changes in the Constitution that would constrain government spending and the growth of government. That's exactly what happened in 2001 in Switzerland. They had a referendum. It passed by, almost 90% of the Swiss said, yes, we want a constitutional amendment. We want to put a Swiss debt brake in to the Constitution. And that debt brake requires the Swiss to balance their budget and to constrain government spending so that it cannot grow any more rapidly than the real growth rate in the US, in the economy in Switzerland, which means that the size of the state relative to the total economy in Switzerland can't grow. It stays the same or gets smaller, but it can't take up more of the economic space than it's currently taking up in relative terms. So that's the way to fix the problem, but that's a long-term thing. The short-term thing, it simply has never been successful. The only three presidents who actually have cut the size of the government relative to the total economy in the U.S. Eisenhower, by the end of his second term, he'd done it a little bit. Reagan also, by the time his second term done, he shrank the government a little bit. The one who really shrank it was Bill Clinton in the 1990s, but that he benefited from what they call a peace dividend.
Yeah,
they could cut government spending because the Soviet Union had just collapsed.
Well, is there a need to spend a lot of money now? We're not at war with the Soviet Union.
No, there isn't. I think they should be slicing it dramatically, maybe 50% reduction. It's not going to happen, but that's if I had a magic wand that could do it, I would cut the Defense Department budget by 50%.
Crux of the question is why couldn't it happen? Too much bureaucracy, or what's the?
The military-industrial complex runs the show.
Yeah.
They've got more lobbyists than you can shake a stick at. They're pouring so much money into these political campaigns, you can't believe it. It's a defense industry, the military-industrial complex. What President Eisenhower warned us about.
Yes,
we live with it, and all over the place. Up there in Canada, when now they're talking about increasing the defense expenditures in Canada. Europe, that's what they're talking about. Just yesterday, Trump is on the tube talking about some harebrained satellite defense system, golden something. It's going to cost billions.
Yeah, I do wonder. I see on social media all the time all these, not ads, but all these warnings against the Chinese ramping up their military spending and whatever new technology they have for their Air Force. I wonder how much of that is just fear-mongering to promote this industrial military complex in the U.S.
Well, probably 99.9% of it is, but
so there's no imminent war that the nation needs to prepare
for. No, who's going to be sending an intercontinental ballistic missile into the United States? It would be insane because the counterattack would wipe anybody else off the face of the earth. It would probably destroy the earth, by the way.
Yeah. All right.
who wants to get into the doomsday machine? I don't think that's very inviting for anybody. I mean, even North Korea, even if they could.
I agree. I just don't see the Chinese being, having an incentive to escalate anything, but that's what I'm seeing in the news. So
Yeah, well, the Chinese are a powerful nation like the United States. They want to get more powerful, but does that include an attack on the United States? Or does that include the U.S. attacking China? I mean, that would be suicidal.
one thing they could do is expand towards the South China Sea. Actually, the U.S. has them encircled with the Philippines, South Korea is an ally, Japan is an ally, Taiwan is an ally, and so they really can't do much. But if they were to, have imperialistic intentions, it wouldn't be to attack the U.S. They would be to expand their sphere of influence. What would the U.S. do in response in that case?
Well, we're watching what they're doing. We're watching what the U.S. is doing. I mean, they're trying to expand their footprint in Asia, and ironically, what China now is creeping in under the curtain of the Monroe Doctrine. They're all over South America, Latin America. So it is a power struggle, but this is what powerful nations do. You always ask a question, David. You say, "Oh, Hanke, is there any historical experience for this, that, or the other damn thing that you've got up your sleeve?" And this, I can tell you, there is a consistent pattern of historical experience with how powerful nations behave. And by the way, the big expert on this is Professor John Mersheimer at the University of Chicago. He studied this. He's written all the classic books, and he's what's called in foreign policy a realist. He's of the realist school. Well, I'm of the realist school too. And historically, this is what powerful nations do. They want to get more powerful.
I believe it was the Truman Doctrine that wanted to contain communism, if I'm not mistaken. But let's go with that. Let's assume that kind of philosophy is still in play. Let's just take the reverse of that. Why do we need to contain the expansion of China or any other communist power? Let's suppose China wants to increase their sphere of influence in the South China Sea. What would happen if nothing were to stop them?
Well, I think the South China Sea and what's going on there, it's all a Taiwan story.
Okay. But
they're pretty solid arguments. It is part of China.
Sure, but do you think
at least let's put it this way, just to keep it simple without getting out in a lot of technical weeds. From mainland China's point of view, Taiwan is part of China, just like Hong Kong is part of China.
Mm-hmm.
So that's what's going on there. The maneuvering around is that's the Chinese point of view.
But what the Chinese
and the American point of view is one of no, that's not the case. The American point of view is no, it's not. We don't want that to occur. So that's the tension there.
Is there, I mean, I understand why China may want Taiwan to reunify, but what is the American case for arguing against that? I mean, from the Chinese perspective, the Americans are not minding their own business, so to speak.
Well, the American case is basically something. We have a Taiwanese lobby. We not only have an Israeli lobby. We have a Taiwanese lobby.
Sure.
Those lobbies influence things.
Yeah. All right. Fair enough.
And so with that happy note, Should we call it a day?
Let's call it. That was a good discussion. We went from inflation to doomsday. If you have any questions for Professor Hanke, please write to him. I'll put the email in the description and the link down below. And where else can we follow you, Professor?
Well, on X at Steve underscore Hanke, we're up, a little north of 800,000 followers. So there's a lot of daily action, and if people want more regular things, they go to X. If they want, you know, if they want a little bit more of a slow boat to China, David, they can email me.
Okay, let's get Professor Hanke up to 1 million followers on X. I think
Yeah, that would be great. I think, yeah, we've got to get into the promotional aspect of things here once in a while.
yes. Follow. Follow.
Speaking of that, on May 6th, my most recent book, Making Money Work, that I co-authored with Matt Sakurki, was released by Wiley. You might put that up too, David.
We'll do. All right, we'll put the links down below. So make sure to follow Professor Hanke there. Thank you again. We'll speak again soon.
Thank you.
Thank you for watching. Don't forget to like and subscribe.